Target reported earnings before the market opened on Tuesday, and if you were just looking at the surface numbers, you would think that this was a pretty bad report by Target. Same-store sales were down, margins are not as strong as they were pre-pandemic, and it just looks like the business is trending downward. But if you take a step back and look at this company, Target has actually had a ton of growth over the last few years, gained a lot of market share during the pandemic, and they're giving a little bit of that back. And I think that's kind of what investors were trying to suss out in the conference call. But it looks like that give back of some of that market share is starting to end, and we're probably going to get back to same-store sales growth after the first or second quarter of 2024. So that's kind of the general theme. That's why the stock is up. It was up double digits early in trading on Tuesday. And I think there's just more certainty around what this company is going to look like a few years from now. The strategy is a little bit clearer, and they introduced some interesting new programs that could add incremental margin and loyalty by some of their customers. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's just go to the report to start with. So this is the earnings press release, and I'm gonna actually go down a little bit just for a second because I think the way they frame things at the top is not quite accurate to what's going on. Total comparable sales were down 4.4% in the fourth quarter. What they say is reflecting comparable same-store sales decline of 5.4% and comparable digital sales decline of 0.7%. So Target is still taking these things a little bit separately. That would be the in-store experience. How much are people spending while they're actually shopping physically in the store? And then how much are they spending on those digital experiences like drive up and pickup? That's about 20% of Target's business now. So that's becoming a pretty sizable chunk of the business. And that had some significant strength over some of the declines in store. But those are, like I said, the kind of those numbers need to be a little bit contextualized because Target did take a lot of market share during the pandemic. I'll just throw up a chart here, and this is the annual chart for Target's revenue, and you can see that revenue jumped from between $70 and $80 billion. That was kind of where they were bouncing around in the mid to late 2010s. And now suddenly during the pandemic, they added $30 billion worth of sales in just 3 years. So what's happening right now is they're basically giving back a little bit of that sales growth to get to more of kind of, I would say, a natural level. This is what a lot of technology companies have gone through over the last couple of years, is getting back to what would be their normal growth trajectory. But I think it's pretty clear that Target has taken share over that period of time, so they're not going to give back all of those sales. The other big thing, operating margin, 5.8%. This is a little bit lower than what you would typically expect from Target in the 6 to 7% range from the mid to 2010s. And then there was a peak in margins when they had that increase in sales during the pandemic. Now that's falling back a little bit, but it's returning from an artificially low level due to some inventory challenges in 2022 and parts of 2023 when the pandemic ended. They basically had the wrong kind of inventory, so they're making some changes there that have been improving on margins, but still not quite back to what you would hope that they would be long term. Shrink costs were lower than a year ago. Shrink is a nice word of saying theft, but they are seeing a benefit from lower inventory costs, lower freight costs. So there's kind of a balance there, and I think the trajectory is at least moving in the right direction. Here were some of the highlights that management wanted to point out at the beginning. This is why I kind of skipped this at the beginning. I think the biggest thing, same day services were about 10% of sales, a little over 10% of sales, and grew 13% in the quarter. This is really where I think Target is going to focus over the next few years. I'll talk about their Circle program they announced in just a second. But that's really where you're seeing significant strength, is just having those physical stores and all the items that you can now order from Drive Up without ever getting out of your car. Adjusted earnings per share, $2.98 per share. So that was above expectations, both from analysts and from Target itself. And let's go down to guidance. This is where you see some of the confusing trends for Target. Guidance for the first quarter of 2024, this would be fiscal 2024, which includes the holiday season, expects comparable sales to decline 3 to 5% and earnings per share to be down to about $1.70 to $2.10 per share. So still a pretty profitable quarter. But for the full year, they expect a modest increase in comparable sales in a range of flat to 2%. So you just put those two things together, and Target is expecting, looks like, pretty significant sales growth on a same-store basis in the back half of 2024. So it looks like the business is starting to kind of bottom out and enter a growth trajectory again. Those earnings expected to be in the range of $8.60 to $9.60 per share. At the midpoint of that range where Target is trading today, even after the bump in the stock, the shares are only trading at about 18.6 times earnings. So not the cheapest stock out there in the market, but also a reasonable value given the consistency and growth trajectory of this company. I do want to highlight a big announcement that they had related to their Circle program. If you're not familiar with this, Target's got kind of a confusing array of products with Circle, with Shipt, with Drive Up, with their Red Card program, and they're trying to at least simplify pieces of that into Circle. So this is basically going to be one unified app and experience, and then Target Circle 360 is going to add in some membership components where for $50 a year for the first year, you're going to be able to get free same-day delivery, most of that within an hour, and that's going to be through the Shipt service that they acquired a handful of years ago, so that not only includes Target, but also other retail partners as well. So really trying to simplify that user experience from the app perspective, and then potentially get people to spend a little bit more at Target by using this membership piece. Can still get the 5% discount with the Red Card. So maybe there's some payoff there, but I think this is an interesting move to try to compete with some companies like Amazon and Walmart who have been really successful with some of their short-term delivery programs. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, one of the things that I took away from this earnings report and the investor conference or meeting that they had afterwards, which was really long and detailed, was that Target really seems to know who they are now. I think this has really been one of the challenges over the last 20 years or so for Target is you had companies like Amazon come into the retail market. Well, now does Target want to just directly compete with Amazon? That doesn't necessarily make any sense because they don't have the same business model or the same cost structure. So they just started losing market share to Amazon, and that was really the darling in the retail space. Then you get to the point where they started introducing a whole bunch of different services. You had Shipt, Drive Up, Pickup, just trying to throw things at the wall and see what stuck. And it seems like what ended up sticking was the products like Drive Up and Shipt. And now it's going to be a matter of spending years redeveloping or remodeling some of their stores to be able to be optimized to those kinds of things. I live near a Target where it's actually really convenient to go do Drive Up. You don't have to deal with the traffic related to people going into the regular store. And there's an entrance right there, easily accessible fridges and freezer space for groceries and things like that for the staff members. So it's been a great experience, but sometimes I'll go to another Target store and it's very clear that the Target store was not built for Drive Up specifically. So they're just trying to shoehorn these things into a Target location. And I think that's kind of the challenge now is they're trying to figure out how do we take these concepts that work on a small scale and then scale them nationally to over 2,000 stores. Starting to do that with Drive Up, adding things like Starbucks, so being able to bring Starbucks out with your Drive Up order where that's available. Now adding returns, the grocery inventory and products have really improved. And then the other thing is moving to more owned brands. And in theory, that should help Target be able to manage their inventory a little bit better, their quality control, have fewer SKUs or number of products in the store, and potentially have even higher margins. Because you're basically white labeling other people's food products or consumer packaged goods. So, and the idea would be that people are shopping at Target, not because they have name brand, they have national brands available, but because they want to shop at Target. So they don't necessarily care about the brands that are there as long as all those products are really good quality. So in theory, those should bring some operational efficiencies, and you could drive growth through some of these digital aspects and people using the app, gaining more loyalty through same-day delivery and Drive Up and things like that. So I think Target's moving in the right direction. Not going to be a high growth company, but should be entering that 2, 3, 4% same-store sales growth by the end of 2024. And like I said, reasonable multiples. So if we get any sort of margin expansion from Target, which I think there is a little bit of room for that, this could be a pretty good investment to just buy and hold. It's not going to knock anybody's socks off. But I do think they are moving in the right direction in retail today. But what do you think of the results from Target and the stock pop that happened on Tuesday? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.